This video has certainly been a long time in the making, but recently I've been motivated to create it because I've been seeing a lot of videos come up in my feed. This trading signal has 100% accuracy, or spot these moves before they occur, or this signal generates 1,287% returns, or whatever nonsense like that. And these titles and thumbnails are largely egregious, ridiculous, and they're just there to get clicks. And they work. I mean, they get tens of thousands, hundreds of thousands of clicks sometimes, but the information that they're offering isn't actually relevant. So what I want to do in this video is I want this to be essentially the last video that you have to watch on trading and investing to understand the space. I want to provide a framework for decision making and understanding what other people are suggesting when they have some sort of signal or some sort of strategy. Now, this is no easy feat. Really, what I'm going to be doing is distilling a lot of the topics that I've discussed in previous videos over several months, along with my academic and professional experience and my day-to-day trading activities, into this video by discussing the ideas of risk and return, my perspective on the market, some of the literature on the topic, how I go about trading, how I go about investing, and how I analyze performance. In economics, we learn that there is no free lunch. This is the case in finance with trading and investing, but there certainly is a free Jupyter Notebook. This one will be available in the description below. I will also post it to the Quant Guild library on GitHub, where you can find all of my Jupyter Notebooks and associated YouTube videos. At the top of this Jupyter Notebook, you'll find some related Quant Guild videos on topics I'm going to be discussing herein. Ideas like applying statistics to the market, why these statistics are incorrect, but that does not necessarily preclude us from generating P&L. So if you'd like to do a deep dive into these topics, I highly recommend checking out these videos. Moreover, if you'd like to support the channel so I can continue to create videos just like this one, and if you'd like to master your quantitative skills, check out quantguild.com. Maybe you come from a background in business, economics, computer science, and you aren't too sure where to begin on your quant journey. Well, then Quant Guild is for you. We have over 90 quant lessons in math, probability, and finance, an adaptive practice engine that scales with your skill level so you can progress to more and more difficult topics, trading games, interview questions with fully worked solutions, and more. So if you'd like to support the channel and master your quantitative skills, check out quantguild.com. Without further ado, let's start with this idea of risk and return. When it comes to trading and investing, one of the most foundational assumptions in all of quantitative finance is that I cannot generate a return without exposing myself to some sort of risk. If I do generate a return without exposing myself to any risk, then I must earn the risk-free rate. That's a nice theoretical discussion, but how does this work in practice? Well, in reality, risk and return are both random variables. We don't know what they're going to be in the future. The best that we can do is some sort of expectation. So typically what we do is we look at expected return and we look at expected risk, and expected risk is really just a measure of return spread. That is the variance or the standard deviation. It's the expected deviation from the expected return or the mean return. So this is how we're going to go about measuring risk and return for a particular investment. Okay, how do we actually get these quantities? Well, we can try to proxy them from historic data. We can look backwards at maybe the returns for Apple, and we can compute the average return and the average standard deviation. Okay, but I thought historic data wasn't indicative of future performance. It certainly isn't, and this is a very difficult problem in finance to deal with. What is a reasonable measure of risk and return? Just because the quantity itself is difficult to measure doesn't mean we don't have a good interpretation of it. Think back to what I had just said a moment ago about the risk-free rate. If we assume no risk and we generate a return, we have to earn a risk-free rate. Why on earth would anybody expose themselves to risk if we can always just earn this risk-free rate? Well, that's because they're going to demand some sort of risk premium for that exposure. They're going to demand a higher expected return for taking on that risk. This is the balance that we always try to deal with when we go about allocating capital. We want to try to maximize our expected return and minimize our risk, our expected risk, our standard deviation throughout the life of that particular investment. Turns out this is a very tricky problem. Just because we can assume more risk, it does not mean that we are going to have a higher expected return. We can allocate capital in a very suboptimal way that actually increases our risk but decreases our expected return. This is the problem that we're dealing with in this space. So it's difficult to measure these quantities, and even after we've measured them, it's very difficult to optimize a portfolio. It's very difficult to optimize trading and investing decisions to maximize expected return while minimizing the associated risk. Why is it difficult? Well, the entire system is time variant. Everything changes over time. So just because right now I'm measuring this blue dotted line and this red dotted line, it does not mean that these lines are going to be the same in a week. It all is based on how I'm producing these measures of risk and return. That is foundational to this space. If this is the case, how does this relate to trading signals? Well, I have an example here discussing a trading signal. We see these videos saying, hey, this signal has 100% accuracy. This generates, 10 million % returns. But what's actually going to happen when you try to trade their signal? Well, really what we're looking at here is this idea of overfitting noise and stability in statistical quantities. They're two different ideas, okay? Now, in those types of videos, if they overfit their model to some sort of back test, then what can end up happening is you'll see a signal that looks like this. This is precisely what we would like to see. What I have here is the lowest signal values are highly correlated with negative returns. The highest signal value is highly correlated with positive returns. I can construct a market neutral strategy. I can trade a long, short portfolio and hopefully generate some alpha. But this is in the backtest. If I deploy that signal in a live environment, it's going to look something like this. And that's because in those videos, they've just overfit their strategy to noise. That is, they've overfit it to their sample data. When you actually try to deploy it in the live market, it looks something like this. That is case one. That's not stability, that's overfitting noise. Case two is stability. Maybe they actually produced their backtest correctly and they assume that it's stable. Okay, they produce a nice signal. Returns are bucketed correctly on the long and short side. We see this roughly monotonic increasing relationship. But when we deploy it live, we still see this. That can absolutely be the case as well. And it doesn't have to be as aggressive as this. It might start out looking roughly like this and then degrade over time to this. And that's the nature of the system that we're working with. We might have a strategy that worked really well at one point, and now it does not work well at all. Strategies pre-COVID that were killing it, 2+ sharp, after COVID, completely lost traction. So this happens over time. Remember, the entire system changes over time. You'll see a lot of models even try to include some sort of regime dynamic. And this can be effective, but it is not a trivial problem to automatically detect some sort of regime and fix this instability over time. So this is something we're constantly dealing with within the space. All right, now we understand this idea of stability. We can see we have some sort of signal that was constructed appropriately in a backtest, but when we deploy it to the live market, we see that essentially the entire performance degrades. This is what we're dealing with when we go about trying to measure risk and return. Essentially, in a backwards looking sense, we are constructing a signal like this. And if we cling to that signal value in a live setting, and we're trying to measure our portfolio risk and return, again, the expected risk and expected return, we may see something like this. Those values, those levels that we produce may not be valid over time. Maybe after new inflation data comes out, maybe after an earnings event, those levels change. And if you cling to those old values, just like this backtest signal, then you're going to do very poorly in managing your portfolio. So you're going to have to adapt on the fly. That is the purpose of this discussion, understanding that this entire space changes so quickly over time, you can't just cling to one model value. Okay, now that we understand this idea of instability, we can talk about risk and we can talk about different types of risk exposures. Remember, when it comes to risk and return, we're dealing with expectations. These are random quantities, so we don't know what they're going to be in the future, but theoretically, if we take some sort of risk, we should demand a higher expected return relative to a risk-free rate. And in equities, there's a lot of different types of exposure that we can have. I'm going to list 3 here. We have idiosyncratic, industry, and market exposure. What does this actually mean? Well, idiosyncratic exposure is anytime I hold an individual stock. So let's say that I hold a lot of Apple stock. I have a lot of exposure to Apple, and if they come out with a new product that absolutely kills it, then I get the benefit of having a lot of my capital allocated to Apple. But of course, it's a double-edged sword, because if there's some sort of CEO scandal or their product flops or whatever it may be, then I'm also at risk of losing money and more money on the downside should I have a lot of capital allocated to that one stock. So that's one type of risk. Another type of risk is industry risk. Same exact idea with holding just Apple, but what if I just hold all tech stocks? Yeah, if tech does really awesome, new technology, products, and tech is just ripping, then I'll get all the reward for assuming that risk. But again, same thing, it's a double-edged sword. What if there's massive regulation, or maybe there are unintended consequences of new technology? Then I'm also exposed to that potential downside. So that's idiosyncratic and industry risk. What about market risk? Well, market risk is about the broader market, broader economy. It's everything as a whole. So things that are going to greatly impact market risk: inflation, interest rates, government policy, things of that nature, all greatly impact market risk. So if we see some sort of rate cut, typically that's a bullish signal. We see some upward price movement. On the flip side, if we see higher inflation, maybe there's reluctancy to cut rates, then we will see some bearish price action. So that's the difference between all of the different exposures when we go about investing in some sort of stock or equity. The very interesting thing here is we can actually diversify away the 2 types of risk, idiosyncratic and industry risk, by holding a lot of different types of stocks in our portfolio. We're roughly diversified at 30 plus stocks across different sectors. Then really all we're doing is exposing ourselves to the market. I have an example of what this could look like here, where I have individual stocks, and here you can see some stocks do particularly well. We don't know which path we're going to walk, but maybe one does particularly well. This almost doubles in price. And then some don't do too great. Some actually end below the initial starting point. And that's the idiosyncratic risk. You don't know the firm's specific trajectory that you're going to be on. It might be a bad year, might be a good year. So you get exposure on the upside and the downside for that particular firm. Okay, well, if you don't want to worry about the particular firm, then you can diversify that risk away. So maybe you just hold 2 different sectors. Maybe you just hold tech and healthcare. So here you can see I'm holding all tech stocks in this blue portfolio. I'm holding all healthcare stocks in this red portfolio. And effectively, I've diversified away the idiosyncratic risk. I'm leaving myself just exposed to the industry risk and the market risk. Okay, well, what if I don't want to worry about the industry risk? Then again, I can diversify that away and I can just be left with this market risk exposure. The thing is, if I invest in one stock, I am going to be exposed to all of this risk. I will be exposed to the idiosyncratic risk, the industry risk, and the market risk. And I'm going to be compensated with expected returns for taking on that risk. If I diversify one away, then I'm no longer going to be compensated for assuming that risk. I'm not assuming that risk anymore. I'm diversifying it away. And by diversifying it away, I'm also diversifying away any potential return. So if I get rid of the firm-specific risk, then I'm not going to be able to benefit as much on the upside, but I also won't lose as much on the downside. Same is true for industry risk, but I can't diversify away this market risk. It's a very important idea. Now we get to choose what type of risks we are exposed to. So which exposures should we choose? Welcome to the space. This is why when somebody tells you they have a trading signal that generates 10,000% returns, that doesn't really make a lot of sense, because if you look at it in terms of risk for return, then you're assuming the risk associated with that signal for whatever instrument they're trading and whatever signal they're trading. But the return is in terms of an expected value. It's a random quantity looking forward. So that's great if they overfit their backtest to data, but it says nothing of the performance in a forward-looking sense. And this is why I'm trying to harp on this idea of expected return relative to some sort of risk-free rate, because we're looking at these quantities in terms of an expectation that we can barely measure. Theoretically, we're going to be compensated for assuming exposures to these different types of risk, but nothing is concrete. So hopefully this sheds some light on the space. We'll look at some more examples here too in a moment. So we'll look at option contracts and different risks associated with option contracts as well. Again, we get to choose what risks we're exposed to. We don't necessarily know what the correct ones are. Maybe it's better now to be exposed to idiosyncratic risk. Maybe it's best to hold Nvidia right now. Maybe it's best to hold Alibaba right now. Who knows? That's the entire point of this space, is we're trying to make optimal decisions in the face of uncertainty to choose what exposures to have and when, to try to accumulate this expected value over time, this expected return. And if we can do this in a positive capacity, that is, if we have some sort of edge in our decision-making process, we will accumulate wealth. Otherwise, at best, we'll break even or lose money. Different financial instruments are going to offer different exposures to risk. Now, just as I mentioned a moment ago, we don't necessarily know what the correct exposure is correct at any given time. There are strategies that we can use to accumulate this positive expected value, but we don't necessarily know what's going to be correct. In a moment, we'll talk about an example in gambling, poker, and trading. But for now, just bear with this idea that different financial instruments are going to offer different risk exposures. So with an option contract, for example, we know that holding that contract is going to give you the right but not obligation to buy or sell a particular asset at a predetermined point in time in the future for a price called the strike price. So at some point in the future, that contract is either going to expire worthless or it's going to be exercised. And that contract has different risks associated with it throughout the life of holding it. You have interest rate risk, you have volatility risk, you have time decay, you have directional risk. Depending on if you're long or short that contract and the type of contract that it is, these values may contribute to your exposure in a positive or negative way. So for example, if I have an option contract and volatility increases and I'm long that contract, then that contract value is going to increase. Well, vice versa. There's no free lunch here. So if volatility decreases, then my contract is also going to decrease in value. So that is what we talk about when we talk about this different type of exposure when it comes to option contracts. So what's an example of trading with this particular type of exposure? Well, let's suppose that volatility tends to decline after an earnings event. This can be the case. Well, what I can do is I can construct a strategy such that I am short this volatility risk, this vega value, and if the implied volatility goes down, this volatility value goes down, all else equal, I'll make money. And that's exactly what I have here as an example. So I'm simulating paths of this option value. And on average, the implied volatility is decreasing. So you can see the average option value is actually decreasing. So if I hold a net negative vega position and hedge away the other risk, then I can collect that theoretical spread in option value. That is one example of a trading strategy that involves this particular exposure relative to an option contract. In fact, the last video that I put out was on building a volatility trading dashboard from scratch to analyze potential edge in these types of strategies. So if you're curious, I highly recommend you go check that video out. Or if you would just like to download the source code and play around with the tool, you can check it out on the Quant Guild library. Now what we're going to do is talk about my perspective of the market, understanding this idea of risk and return, understanding this idea of exposure. Regardless of the instrument that we're trading or investing in, we have this market exposure. So if I have one stock in my portfolio, if I have an option contract or a tracking ETF, whatever it may be, I have this market exposure. And I want to discuss how we should think about this exposure to the broader market, because I feel a lot of the time the actual implications of what is going on is lost, and we just kind of look at these numbers like interest rates or inflation, and we don't think about the behavioral component that goes into it. And this is where poor decision making tends to occur. So in general with the market, fear dominates and volatility reverts to a mean level. There's plenty of academic literature to suggest this. I'm not going to cite 100 studies, but I'll just share one, a classic one from Schiller, that is, retailers and institutions have no idea what's going to happen, and they always overestimate the probability of a crash, recession, whatever it is. And what does overestimate really mean? Well, this kind of brings it back to the original idea of, is historic data indicative of future performance? Not necessarily, but relative to that historic data, it's certainly overestimated. So in this particular study, the probability of a crash, that is a crash observed in 1929 or 1987, a very severe drop, was overestimated by roughly 6 to 19 times higher than what historic data suggested. And the reason I want to emphasize this is because trading activities are really akin to like rocking a boat. Trading activities and volatility. And I've used this example before on this channel, but imagine that you're on this like beautiful glass lake, right? You're sitting on a boat and there are a ton of other people there sitting on their boats, and the waters are nice and calm. Okay. Then somebody hops up, turns on their engine and starts driving away. Starts getting pretty choppy. Why is he driving away? Maybe I should drive away too. Why are those two guys driving away? Maybe I should drive away too. And so on and so on and so forth. And that glass lake just became super, super choppy. But super, super choppy doesn't last forever, and eventually it normalizes back to the glass lake that it once was. And that's a good analogy for what's happening within the markets when we see these types of drops. So I have a time series of the S&P 500 here with vertical lines that outline the drops in one day that were greater than 10%. And we see this one, 1987, 1929, and this one in 2020. And that was from, the pandemic. But really what I'm getting at here is this particular study is suggesting that the probability of that crash, this type of massive crash within the next 6 months, was overestimated by roughly 6 to 19 times what was suggested by historic data. So if that's the case, traders, again, whether they're retailers or institutions, they don't necessarily know what's going to happen, but fear certainly drives decision making. And when it comes to volatility and the leverage effect and this idea of a glass lake becoming super choppy, we see that periods of high volatility tend to follow periods of high volatility. And eventually it normalizes and reverts back to some sort of mean level. But these spikes in volatility, they're not just isolated, right? They have this sort of decay to them over time. They're clusters. So we see a combination of what's called volatility clustering and this so-called leverage effect. That is, when returns drop, volatility increases disproportionately, this uncertainty measure, and we don't necessarily know what's going to happen. And it's the same thing as everyone turning their boats on and leaving. We don't know why they're leaving, but maybe we should leave too. Whenever this happens, it creates a ton of mispricings. It creates so much opportunity for hedge funds, quant funds, whatever you want to talk about, to come in and make a ton of money. If you look at a bull market's boring. What do? You buy and hold. There's no opportunity for trading. But in periods of extremely high volatility, goodness gracious, is there ample opportunity because there's fear. And when people are irrational, they're buying and selling irrationally. And there's a ton of mispricing. So, NVIDIA is at 181 right now. Earlier this year, it hit 90 something. The present value of their potential cash flow in the future did not change all that much. Severe mispricings from fear and tariffs caused that. So, when we look at these environments, we look at the broader market, we want to keep this type of environment in mind, that really fear dominates decision making and volatility is going to revert to a mean level. So when there's blood in the water, you shouldn't be afraid. You shouldn't sell for a loss. You should buy more. You should decrease your cost basis if possible, and that is really the goal. So when I look at market exposure, I'm really looking at these periods of high volatility, what is severely mispriced, and what I can catch on a very nice swing when that volatility reverts back to the mean level. So this is how I like to think of market exposure in general: is fear dominates, volatility will return to a mean level. Largely, this is based on the idea of volatility clustering and the leverage effect, but this is the general gist of how to think of that market exposure. We've covered a lot of ground here in understanding the trading and investing space. We know why those videos titled, 10,000 million % returns are ridiculous. We know that there's this instability over time. We know that there's this idea of risk and reward, and we're compensated in some way for taking on certain types of risk. We know we can do that in an optimal and suboptimal way. We'll talk more about that later. We talked about this market risk exposure that we are all subject to, how we go about thinking about fear in the space and mispricings and opportunity to trade and invest when there is a lot of fear and mispricings. Now we need to talk about this idea of implied probability, because this is something that you're going to see a lot, especially when it comes to market exposure. You're going to see something like, traders are pricing this in at roughly 90%, or economists have this at roughly 75%. And what these are probabilities, right? The probability of this occurring, but those probabilities are measured in a forward-looking sense. They're not actual probabilities. There's a very big difference between an implied probability and an actual probability. To understand why implied probability is different from actual probability, I have two examples here. I have a coin flip and the probability of heads, and I have this game known as the St. Petersburg paradox. If we look at the mean probability of the coin flip, as we increase the number of coin flips, the mean converges to the true population mean. In other words, if I continue to run this, you can see that this horizontal gray line is what the blue line, that is the sample that we are observing, is going to converge to. That's what convergence means. When we talk about the law of large numbers, we're saying as we increase that sample size, we're going to eventually converge to that population mean value. So we know that a coin flip is 50-50. And this isn't a formal proof, but I just simulated 1,000 coin flips. And you can see that that mean probability of landing on heads is certainly converging to that theoretical gray dotted line, this gray dashed line of 0.5. Okay, so this is an example of convergence. That is probability. In the frequentist sense, that is probability. If I was to flip 10,000 coins, On average, if I simulated that 10,000 coins an infinite number of times, I would see 5,000 heads and 5,000 tails. This is what probability is in terms of the interpretation. It's a proportion of outcomes if I was to do that same experiment a large number of times. That's what we're looking at here. Well, what about when we look at something like the St. Petersburg paradox? There is no convergence here. If I run this, you'll see this gray dashed line is at roughly 10 here. If I run this again, now it's above 10. If I keep running this, it's going to keep changing. That's to say that this game does not converge to an actual value. This is more akin to implied probability than coin flip convergence. So when we think of implied probability, how should we think about it? Well, if the implied probability of an event is 90%, all that's telling you is the money thinks that it's going to happen based on the odds, based on the market. Whatever people are putting their money on, they certainly think that that outcome is more likely. It does not mean that if we had that particular outcome 1,000 times, that 900 of them mean that that outcome would occur. That is the interpretation with a coin flip. That is not the interpretation with an implied probability. That is a incredibly important distinction to make, because if rate cuts, let's say rate cuts currently have an implied probability of roughly 60%. That means there's a lot of room, there's some edge to trade if you think that maybe there's a misinterpretation in that implied probability. Maybe it was cited incorrectly and really it should be 80%. Maybe it should be 40%. If you have a discrepancy in what everybody thinks is the case and what actually is the case, then you have some edge there. But again, we're not talking about an iterative experiment. We have something that isn't actually converging to a stable value. But what it is telling us is where the money currently is. And that is the most important part here, because if you do have a discrepancy, then you can have some edge and you can trade around it. And in a statistical capacity, if you're right, on average, you'll accumulate P&L and wealth. This is the exact same idea as implied volatility. When we back out implied volatility using the Black-Scholes model and current option prices in the market, we're getting what traders are currently pricing volatility at. We are not actually getting what the volatility is going to be in the future. It's just what everybody thinks right now. I have a very simple example here with American odds in a sports betting case, but really what we're doing here is the exact same thing that the Black-Scholes model is doing for implied volatility. If we have some sort of odds in a market, then what we're going to do is back out the implied probability based on those odds and where the money is, and we're going to get what the market currently thinks the most probable outcome is going to be. But again, those probabilities aren't saying anything in terms of frequency of outcomes. It's just what everybody thinks is going to be the case. Maybe there's more certainty, maybe there's less certainty. If there's 90% implied probability, then people really think the outcome is going to happen because they're betting their money on it. But it's not suggesting that if that particular event happened 1,000 times, 900 of them would be that particular outcome. That distinction is very important. What this does tell us is the impact of the potential outcome. And this goes back to what I said a moment ago with rates. And I have a nice chart here to illustrate this idea. So let's say that the implied probability of a rate cut was 90%. Okay, well, let's say they cut rates at this time here, this dotted line. Look at that impact in the market. It's not a lot of impact here. But what if the rate cut was priced in at 60%? Look at this jump when rates are actually cut. That is the significance of this implied probability, because we are essentially correcting a belief when the event is actually realized. We're either affirming it or correcting it. So here, where there's more uncertainty, there's more room for impact. And that's this idea of implied probability and why it's important to understand, because it's not a frequency interpretation like a coin flip. There's a very big difference between a probability of heads and the implied probability of a rate cut, right? There's no convergence. It's based on unwinding where the money is. In poly market, for example, it's based on supply and demand for a particular contract. We'll discuss that in a moment. But how you should think about implied probabilities is the impact in exposure to that particular item. So if I have market exposure, we know that a rate cut or lack thereof is going to greatly impact the whatever vehicle for my investment I have exposure to. If I have equity, if I have option, whatever contract I have, whatever instrument I'm trading, we know that rate cut's going to impact it. So if it's priced in at 90%, then maybe if it gets cut, not so much of an impact. But maybe if there's more uncertainty, there's going to be a massive impact, and vice versa. Because if there's a 90% implied probability of a cut and it doesn't cut, then this is going to jump way down. And vice versa for the 60% up here. So just keep that in mind as you're operating with this implied probability space. What I have here is an example of poly market, which is just really a market for these implied probabilities. And the contract's value has this binary outcome, 1 if true, 0 if false. That is the value of each one of these particular contracts. And this is very similar to a Bernoulli random variable that's being used to generate model probabilities, but it's exactly the same as the idea of a non-convergent process that we talked about in the case of the St. Petersburg paradox. So when we come down here and we look at the rate cut, really what we're dealing with is this non-convergent process. Moreover, if we're considering the example in the S&P 500 that we talked about above, where the implied probability, that is, traders and investors polled, had this 6 to 19 times higher probability than what was observed historically in a severe crash, we know that implied probability doesn't converge as well, and it's wrong. So when we look at this market overestimation of an implied probability of a severe crash, look at the actual probability, right? It's fundamentally different. So when we actually go about making trading and investment decisions, we want to keep this in mind that fear dominates, uncertainty dominates, volatility reverts to a mean level, but also these measures of probability are not actually probabilities. It's implied probabilities. And these implied probabilities just tell us how much impact we can expect potentially in the price of some sort of instrument in our portfolio, given something does or does not occur. So if we have a 90% priced in rate cut and rates don't get cut, we're certainly going to feel that, right? That's going to be a massive drop relative to if, the rate cut's actually realized, and it's relatively smooth sailing. Everyone was expecting that. I want to briefly touch on psychology here, because in the algorithmic and quantitative trading sense, we often hear this idea that this type of fear and uncertainty is kind of like hedged away, or it's like mitigated because everything is systematic. And I just think that idea is kind of ridiculous, because fundamentally you still have risk exposure. We're not talking about static arbitrage here where you're immediately buying low, selling high, or some sort of exchange arbitrage. I'm not talking about anything like that. Somebody's manning the helm. Somebody is responsible for assuming that risk exposure. And if a human is in charge of that system, then psychologically, there is still a component of fear to it. Okay, there absolutely is. Making money does not feel as good as losing money feels bad. That is objectively true. So in terms of psychology, if we're trying to construct some sort of argument that, algorithms make the behavioral component of all of this moot, it's a ridiculous notion based on the behavioral finance and psychology literature. So with that, we're really getting a good picture of the trading and investing space. We're now ready to talk about how I trade and invest. We have a very good understanding of the trading and investing space at this point. We understand that we need to assume risk to generate a return. We know that there's different types of risk that we can assume to generate different types of return. We know that there's a lack of stability in the space for measures of that risk and return. We know that there's a psychological component to this as well, with what people are expecting versus not expecting in terms of an implied probability, a fear component that, typically fear will dominate mispricings for a brief while when volatility clusters. Then eventually it reverts to some sort of mean level and all is well in the world again. So understanding all this, we can talk about how I trade and how I think about trading. And to do this, we need to talk about this idea of edge, gambling, poker, and trading. I've talked about this before on the channel, but nevertheless, it is critical to operating in this space because the entire space separates winners who understand the idea of trading, investing with edge versus losers who don't. So we're going to talk about the idea of a game of chance versus a game of incomplete information to hopefully hammer this idea home. The idea of a game of chance is that there is no optimal decision to make in the face of uncertainty. Statistically, if you continue to engage in that particular game, in that particular investment, if it is a game of chance and you have a negative edge, you will lose all your money. If you play something like roulette and you're not allowed to use some sort of martingale betting strategy, then statistically you will lose money if you continue to play until you are bankrupt. That is a game of chance. That's why gambling should receive negative connotations. You cannot, in a game of chance, generate P&L. There's no optimal decision to make. In fact, if I was to take a reinforcement learning algorithm and try to teach an AI model to learn to play a game of chance like roulette, it would learn nothing beyond the probability mass function, and it would also lose a whole bunch of money. That is not true with the game of incomplete information. We can teach an AI model to play poker and absolutely smoke everyone. We can teach an AI model to optimally delta hedge an option portfolio. Poker and trading are games of incomplete information where you can always act suboptimally. I can bet pre-flop my entire bankroll. I can also buy low and sell high and accumulate an infinite amount of transaction costs. I can always act suboptimally. And acting suboptimally is so easy without relevant information or appropriate information of understanding how to engage with the space that it seems like just gambling, but it is not. It's because you're operating in a way that you're just accumulating a ton of negative expected value versus those that understand the idea of expected value, playing as close to net zero positive EV as possible. And you're not going to just be gambling and accumulating negative transaction costs or edge over time, but you're going to be making optimal decisions in the face of uncertainty, accumulating that edge, and the rest is history in your wealth path and P&L. That is the point of the space, and that is how you can operate in an optimal capacity. You can always operate suboptimally and lose money, but the goal is to act optimally. So how do we act optimally? You need strategies, not strategy one. You need strategies, plural. If you're trading in some sort of discretionary capacity, that is, you are actually going to go in and manually execute a trade rather than develop some sort of algorithmic system to do it for you. That's a different type of strategy altogether. Regardless, you need strategies, plural. We're not here to make one trade and be done. Trading is not a part-time job. You need to accumulate EV over time. You can't just walk into a poker tournament and beat the pros. That's not going to happen, right? Same thing is true with trading. You're not going to just make a ton of profitable trades because somebody told you what to do. No, it comes down to statistics, repetition, and being able to understand when there's EV on the table and when there's not. Sometimes you're going to be wrong. So when I trade, I have a series of strategies that I'll look at based on my opinion of the market, my opinion of news, and based on the current climate and activities that are going on. So with an earnings event, if I think implied volatility is overstated, I'm going to look for negative Vega exposure. That's the exposure that I'm going to want access to. If I'm unwinding a long-term investment, I'm going to sell calls above spot. If crypto is mid-range of a bull cycle, I'm going to have directional exposure. Same thing is true if I see risk coming off the books or profit-taking activities. then maybe I'm also going to want directional exposure. I'm not always correct when I construct strategies and trade based on these ideas. I'm not. But I am correct on average, and that's why I continue to make money. And this past week, I did this video on the volatility trading dashboard. I mentioned it earlier. Really emphasizes that idea, because what it's doing is it's systematically running these regressions, looking at something called the volatility risk premium. That is this idea of implied volatility being overstated and then realizing at a lower value, and you can capture that spread. Statistically, that framework that we build in that video shows that there's some sort of edge there. But that doesn't mean that you're going to make money every single time. Sometimes that negative vega exposure is going to crush you and you're going to lose money. So I have an example here of how I would trade in this capacity. So we're understanding that I have a series of strategies and I'm going to trade based on what's happening in the market. I can't trade all the time. Sometimes nothing's happening. Bull markets are boring. But if I see some sort of event, right? Like let's take a look at earnings here. So here's an earnings event. Okay. Volatility spikes way high. Okay. Well, this goes back to what we talked about with the option contract. This goes back to what we talked about with the option contract exposure. I need that volatility exposure. If I think that volatility is going to decline, that is one of the strategies that I've stated here, then I want to be net short that volatility. I want to be short what's called vega. What about my other exposures? Well, I don't want to say anything about the other exposures. So what I'm actually going to do is hedge all those other exposures away. And if I'm correct and volatility realizes lower and implied volatility comes down, then I can collect the profit difference between the contract priced at this high volatility value and the contract priced at this lower volatility value. Holding all else equal, again, I'm hedging away that other risk. This is how I trade. I look for edge, and then I try to accumulate that edge over a series of trades. This is not one trade. This is not 10 trades. This is hundreds and hundreds of trades. So if that's how I trade, how do I invest? Well, investing is fundamentally different because I don't particularly care right now if it's going to go up or down. This is a long-term investment. I'm going to allocate cash to some sort of market exposure or maybe another exposure for a longer period of time. So maybe if I want NVIDIA exposure for a long period of time, I will hold a larger amount of NVIDIA. If I want just market exposure, I'll just hold some sort of ETF or a diversified portfolio of equities that I might rebalance periodically. So when it comes to investing and how I allocate cash, there really is no such thing as timing. It's about time in. So in terms of long-term investing, weekly allocations for that market exposure are productive. You don't know if it's going to be up or down, sideways, whatever it is, but weekly allocations can help decrease your cost basis. So instead of just lump sum dumping it in at some sort of relative high, you can actually decrease your cost basis by just allocating smaller amounts of that lump sum over a couple of weeks. Just one way to go about the long-term investing. Now, when the VIX spikes and there's a ton of fear, this is where I look for longer-term investments, and I will have some sort of lump sum allocation or larger allocations on a tighter time frame because I know there's a severe amount of mispricings. So what does that actually look like? Well, here I have a very simple example of the volatility of the S&P 500 and the difference between a lump sum investment and incremental investments when volatility spikes. So the rule essentially here is when volatility is above a certain threshold, I'm going to allocate increments of that lump sum rather than just allocating that lump sum itself to the SPY ETF. And what you'll see here is, in this particular case, the total lump sum investment of $5,000 has a 1,284% return over this entire time horizon. And the incremental investment actually has a higher average return. So it had a lower cost basis. This is 1,333% return. These numbers are not wrong. They're not egregious. They're not outstanding either. This is over the course of what? It's like 30 years or something like that, 30, 40 years. So This is nothing that, you should be too particularly shocked to see. This is if we bought somewhere in the 80s. But the same argument can be constructed for, closer time periods to the present, 2000s, 2010s, 2020s. Largely, this is just an anecdotal example of how you can go about allocating capital to ETFs in an incremental capacity versus a lump sum capacity. And this is an anecdotal example of where it outperforms. So when it comes to investing, you have a lot of different options, but that is how I look to invest. I look to invest in weekly allocations, specifically for that market exposure. These are long-term investments. You can also look at specific exposures if I think something like maybe tech is going to do particularly well in the next year or two. It's akin to sort of swing trading, but over a longer time horizon. If there's a massive spike and fear, I see a lot of mispricings. I'll have some lump sum allocations or tighter allocations on a time basis. And then here, we didn't really talk too much about this idea of generating cash, but this is going to go into my performance metrics too. If you talk to somebody about performance metrics, you'll say, hey, does your strategy beat the market? That is one of the most ridiculous commentaries I've ever heard, or comments about strategy performance. And it's because there's so many different measures of performance, and beating the market is not just okay, I beat the market, so that's a good strategy. It doesn't work like that. And I've seen people comment, hey, this won't even beat the market. It's that's not the measure for success. That's not the only measure for success, especially if you're trading or investing in a retail capacity. And we'll talk about why now. We can always look at something like the Sharpe ratio or the Sortino ratio to assess the relative effectiveness of our strategy in terms of expected risk and expected return. But this gets back to the original problem we were discussing at the start of this video, is we know that these values are not necessarily stable. So these ratios then necessarily will not have to be stable. And if they're not stable, just because we see something that has a high Sortino or a high Sharpe ratio, does not mean that it's a good strategy. If you have a systematic trading strategy that is stable, if you have a quant trading strategy that is stable, what you will see is this backtested signal value will appear very similar to what we see in the live market. Here it's not the case, but if we saw the bar chart look something like this in the live trading setting, then that is reasonably stable, and we may see the expected returns and the expected risk also be stable. And if they're stable, then so will the Sharpe ratio and Sortino ratio be also stable. But this is not necessarily the case, and that is also subject to change over time. Super important to understand that in terms of a performance metric, these are not just the be-all end-all. This is actually very similar to the idea of an implied probability. Just because that is the case does not mean that it's going to be the case in a forward-looking sense. We're always dealing with this expectation. This expectation doesn't converge to a level, and that's what we're going to be dealing with here. So, if you ask me, hey, Roman, are you going to lever up on a system that has a 2+ Sharpe ratio? I will say, no, I don't know anything about that system. How hard is it to trade? What kind of strategy class is it? What am I actually exposing myself to? What is the maximum drawdown? All of these things are relevant, right? Just because something has these statistics does not mean that this is going to be the case when you deploy it live. There's all of these considerations. So in terms of performance, I don't like clinging to these ratios unless we're talking about some sort of institutional grade strategy with stability. We can entertain these values there, but I think a lot of retailers get hung up on these values, and it's like, wow, that has a very high Sharpe ratio, high Sortino ratio, without actually, getting into the risk and return stability and what it actually means for the trading strategy. So what do I consider in terms of performance metrics when I trade and invest? This isn't right or wrong. This is what I consider. How did I go about generating those trading or investing decisions? Were they generated actively, passively, algorithmically? When did I have access to capital? I'm not talking about liquidity, whether or not I can get out of a trade. I'm saying what proportion of time was I in cash to make decisions with? Not a lot of folks are going to consider that. If somebody outperforms me buy and hold, let's say that they make 20% and I make 15%. But 50% of the time I was in cash and they were locked into an asset, fundamentally that's completely different. I have to use that money. I have rent, I have to pay my bills. So as a trader, I know that there's a suboptimal way to allocate my capital, and I know that I can generate money using that capital in different ways, but also I need to use the capital for different things. So keeping that in mind is also important. It's also time to take profits at some point and use that capital. Not a lot of people think about that. So, outperforming the market and buy and hold in that sense is not the measure for success. So, I'll consider these types of ratios. I'll look at my expected return, expected risk. I'll look at my probability of winning a trade, probability of losing a trade. And over longer time horizons, I'll consider things like how much cash did I have on hand, what proportion of time was I in cash, things like that. To summarize, this video was all about understanding trading and investing. You must assume a type of risk to receive a return beyond the risk-free rate. We're not talking about static arbitrage here. Simply, we need to choose whatever exposure we want exposure to. Statistically, if that exposure at that particular point in time has edge, we will generate P&L over time and make money. Otherwise, we're going to lose money or at best break even. We're operating with incomplete information. We can always burn money. We can always act suboptimally and accumulate infinite transaction costs. But that does not make it gambling. Same thing in poker. I can always bet a ton of money and fold. Does not necessarily make it gambling. It's a game of incomplete information. Stability of strategies, risk measures, performance measures is never guaranteed and is quite rare, even if you can find statistical inefficiencies in the market. So if you're trading in an institutional capacity, you have some sort of strategy that works really well, it's not guaranteed to work forever. Trading is a part-time job. No, it's not. Investing can be. Certainly choose whichever you have sufficient knowledge and capacity for. Okay, that largely summarizes this video. I will say I hope this provides a useful framework for analyzing strategies that people propose and those videos that give you a signal that has 100% accuracy. Some future topics of discussion, if there's interest: time series analysis. This one I think also is a long time in the making. I have this comment here why it doesn't work. Of course, time series analysis has its place. I've deployed production systems for pricing and market making using time series analysis. The why it doesn't work is really my own personal vendetta against it. In an academic capacity, when you take a time series analysis course, whether you're an undergrad, in grad school, or even in some papers and seminars in some sort of PhD program, the first thing that they're going to do is tell you that you're dealing with some process that's stationary. That's not the case ever in real life. Even if that is not the case, it doesn't make it useless. As I mentioned, we deploy production systems using these techniques. So I'll get around to talking about time series analysis, no doubt. I've heard some comments that would like me to discuss this idea. Other topics, I'd like to talk about algorithmic investing systems to generate cash and hold for drawdown. This goes back to that idea of how I invest, maybe at times of high volatility, putting more incrementally putting more cash in versus periods of low volatility. Could be an interesting topic for a video. I want to build more trading tools and systems using interactive brokers. If you're unfamiliar with interactive brokers, link in the description below to get started with them. I've been trading with them for roughly 10 years, over 10 years, I think at this point. I'd have to actually go back and look, but quite some time. They're the best broker that I've used to trade in a discretionary or algorithmic capacity. Highly recommend them. More videos on tools and systems in the future. Deriving option pricing partial differential equations, I think, is a very important idea. We talk about pricing a lot on this channel, but we don't really talk about how to get to that partial differential equation and then how all the solutions are connected. I mean, simulation, you could use Monte Carlo simulation. You could use finite differences. You could solve it analytically. All these solutions are connected. So we'd like to talk about that. Arch and Garch for modeling volatility. Not sure how much interest there would be in something like this. But I've done a lot of work on Arch and Garch models, so I'd be happy to discuss if there's interest. And simulating stochastic processes is a personal favorite topic of mine, so I'd be happy to talk about this also if there's interest. But that is that is going to do it for this video. I hope you enjoyed. I hope you learned something. If you like this video and you want to see more like it in the future, please like, subscribe, comment. It helps me out a lot. Check out quantguild.com to master your quantitative skills. Other than that, thank you so much for watching, and I will see you in the next video.